To make a move like that, you have to have kahunas and conviction.
Long term, I'm bullish. We could see about a 20% correction next year.
This is Josh Jelinski, the financial quarterback. Don't touch that dial. Tax loss harvesting is a solid strategy that many advisors use to help mitigate the bite that realizing capital gains can impose on clients in taxable accounts. When clients sell appreciated holdings, these gains can be offset in whole or in part by realizing losses on other holdings in the client's portfolio. While this can be a good way to try to minimize your tax bill, like any planning strategy, tax loss harvesting should only be done when it fits with your overall investing and financial planning strategy. Too many investors will say, I want to tax loss harvest, but then they don't really focus on capital preservation concerns or diversification concerns. Part of the discipline of financial planning, what is your highest priority? Do you care about diversification and capital preservation above taxes? So, because sometimes you don't want to let taxes wag the dog, but sometimes you do. Really depends on you. So there are like 3 or 4 priorities that I see people when they're building a portfolio: taxes, loss aversion, opportunity for gain. Let's be honest here. Are you greedy? Do you like to make money when others are making money? And you don't care if you're losing? So different strokes for different folks. You might say, I want to make the most I can with the least amount of risk. Well, that's not exactly possible. So you have to kind of rank your priorities. You don't want to run afoul of the wash sale rule. The wash sale rule states that an investor cannot purchase the same or substantially identical security as the one sold for a loss within a 61-day period of having made the sale. This includes 30 days prior and 30 days after the sale plus the day of the transaction. So you got to wait 62 days. Let's say you sell an S&P 500 ETF, you want to buy it back, you got to wait 61 days plus the day of the transaction. This spans not only the client's taxable accounts, but also activity in a retirement account such as an IRA. The same security is fairly obvious. There are some different opinions regarding the term substantially identical. So for example, Company 1 has an S&P 500 fund. Company 2 has an S&P 500 fund. So use Fidelity, use whatever, Schwab. You can look to buy other things that are not identical, but might track with the overall market, but you can't buy an S&P 500 fund. While there are no penalties for a disallowed tax loss via wash sale, the loss of the tax deduction here can result in a surprise for you come tax season. Be sure to work with the appropriate experts in the firm you're with or externally to establish guidelines regarding replacement securities and avoiding violating the wash sale rules. For example, we're happy to work with someone's accountant, and the time to do that is not like during tax time, it's right now. Number 2, identifying replacement securities. When selling a holding to harvest tax losses, you will generally want to purchase a replacement holding for your portfolio. This can be important to maintaining your target asset allocation. Again, you will need to be cognizant of the wash sale rule. While selling and buying the exact same stock or ETF is clearly a violation, what does or doesn't constitute a substantially similar holding can be a gray area.